So once again, welcome everyone and good evening. Thank you so much for your patience. Before I begin the session, you can please use your chat options to just test it. If you can see my presentation, if you can hear my voice properly, just write yes or okay, and you can test your chat options that way. So that if you have any questions about today's topic, please go ahead and ask while the session progresses, and I'll try to answer the question as we proceed towards the session. So if you can hear me properly, write yes or okay. So I would also know that your chat options are working fine. And I'll be ready if there are any questions about the set topic. Right. Yes, yes. Okay, 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 okay. Perfect. So I see most of you have already said okay. So I am assuming that everybody can hear me, right? Just in case if there is any problem with the network, or if you're not able to continue further, you can always go on YouTube and find out the recording of this session. Most of the people normally like to attend the live sessions where they can ask questions, and I'm able to answer the questions. But as I said, that up to you. Give your time and ask as much as you want. And today we are going to be talking about what is going to be the strategy for 2024, and how do we navigate through the financial terrain, because the last year has been phenomenal. And when I say phenomenal, it has been full of opportunities, but it has also brought a lot of challenges. It was perceived that the recession was certain, and it would arrive in 2023, which was this year. And the recessions that seemed so certain to arrive 2023 may simply have been delayed, because at the beginning of the year, the 10-year bond yields we saw were around 3.9%, and the US federal rate was forecasted to peak around 5%. Now, while treasury yields are significantly higher, while we are discussing this, expectations for the Fed funds is rates is not very far off. Now, at this point of time, we see that the US inflation has come under control, right? This is something which is a good thing in terms of the rate hikes which have happened. That has impacted, and we have seen that finally the inflation rate, which was almost 10%, came down all the way to a significant portion, 3.1%. And that's good, because uh, a high inflationary environment was also bad for tech stocks, while we have seen the tech stocks falling down a lot in 2021 and 2022. And how finally in 2023 we saw a slight rise. And as we summarize how 2023 has been, 2024, if we see the outlook, initially the first half is expected to be slightly slower, but then we might see a certain growth coming in, because there are a lot of events which are going to happen. And that is the reason that why we need to be very careful and very balanced when it comes to the trading, and or when it comes to the investment. Now let's start the session here. What are the 2024 key events which we will be keeping an eye on? One of the most important things, the geopolitics. The 2023 has shown that there have been a lot of tensions around the world, whether you talk about Israel, Palestine, whether you talk about as we see that most of the time, the war situations which we have witnessed throughout 2023, it has been a very crucial year, because at the end of the day, uh, the world has gone through a very challenging year. And this is going to be equally challenging, because what is going to happen now? Uh, we are looking at a very important geopolitical backdrop, and there is a great divergence across the key regions, and that compounds the uncertainty and the market volatility for the investors. So the risk for the geopolitics, it's going to be the very key threat to the economic outlook of 2024, because the wars which are converging right now are very large scale. And we must not forget, there are very important elections also coming up, and a lot of world's financial institutions, if even if we try to map out the investment landscape for the next year, there's a lot of geopolitical backdrop, and there is a lot of compounded uncertainty along with a lot of market volatility which is going to happen. There are, of course, there's Israel Hamas war, which is a very significant risk to the global economy, and it's going to be there over the next 2 years. You talk about relationship between China and Taiwan, and Russia and NATO, which is very widespread. And the geopolitical tensions, it was a top business concern over both the near and the medium term. 62% of businesses, they are worried about geopolitics, and it's a very significant risk to the global economy. You talk about oil prices, you talk about deglobalization. This is something which is really important, and the geopolitical tensions have actually slowed down the economic growth. And again, it is expected to slow down while we see a lot of divergence between the regions. Of course, in US, strong growth is projected, and again in large emerging markets. But if you see China and if you see the euro area, so really expected to struggle. So I think it's really important uh, that the war which we have seen back this year, whether it's Russia, Ukraine, Israel, Hamas, or if we see the upcoming tensions which are building with China and Taiwan, uh, we have to navigate very carefully, because the global trajectory is towards more frequent conflicts, and it has a more increasing consequence, because the current conflicts which we see are definitely going to depress the growth further. It might add to inflationary pressures like what happened with Russia and Ukraine, and this time central bank may not be available to support, and it could be beyond the support provided by central bank. So obviously the Russia Ukraine conflict might as well extend to 2024, because there has been a Ukrainian counteroffensive losses momentum due to the winters which are coming. And again, there are still very concerns over the reliability, how much Ukraine can actually rely on Western funding and military aid. So I think at this point of time, if we see from a Middle East perspective, there is a combustible situation. The Israel-Hamas conflict and to nearby states, which includes Iran, that might spiral into a regional conflict with the global and military implications. So the primary risk of this form of escalation would be a disruption of the energy supplies which comes through the Strait of Hormuz. Now, 20% of global oil supply is shipped through that Strait of Hormuz. So that might impact the oil prices. Again, in early 2024, Taiwan elections will set the stage for the rest of the year. And the Democratic Progressive Party is currently well ahead. Now, if that particular party wins, it would likely to escalate more tensions between China and Taiwan, because this particular party is seen as a favor of formal declaration of independence, which is a red line for the Chinese government. So, of course, this is something which is really important, the geopolitics and the war situations, and that's why we have to closely look at these particular things. Even when we are taking decisions on our portfolios, we have to understand that these are the important part. You talk about market volatility, you talk about geopolitical tensions between China and Taiwan, between Russia and Ukraine, between Israel and Hamas, and this is going to impact oil, it's going to impact growth, it's going to impact stocks and other commodities as well. So one specific event which you very closely should keep an eye on and try to protect your portfolio against is the geopolitical tensions in the year ahead. Second thing, the everybody is thinking about the question: will the Fed cut rates in 2024? What it's going to be? So, if we see from the Federal Reserve's perspective, there has been U.S. Rate increase in last 1 year. Um, Total Fed has increased the rates around 11 times in last 2 years, and the 2023 alone, the rate hike happened around 4 to 5 times. And now the question is, will the Fed cut rates in 2024? Because inflation seems to be coming down. That is possible. Inflation will likely settle, and that's a good thing because uh, still we should try to hedge against it because the near term path for inflation is lower, right? Um, One, it's really important to mention that the circumstances that caused the interest rate reset, in order to explain our perspective on this course, in 2021 and 2022, inflation just increased globally, and all the central banks, they very aggressively increased the interest rates to control the inflation, except Japanese central bank, which is Bank of Japan, and People's Bank of China. Except these two banks, most of the central banks, they increased their rates very aggressively. Now the short term interest rates quickly moved higher, and that impacted the long term bond yields, right? Now, one possible reason for this move, investors are starting to believe that inflation will be higher than it was late 2010. But the whole point is, uh, we are looking at the inflation currently, and it's decelerating, and not just within US but outside US as well. In developed world economies, it has declined to around 4% from a peak of 8%. That is good. On the wages front, if we see the labor and demand, and the labor demand and supply are pretty much better in balance. The gap between job openings and unemployed workers in US has come down. So that's something which is really good. But the central bank, I think, they will still continue to look for further moderation because their target is to bring inflation down to 2%, and currently it's around 3.1%. So I think the current interest rates, as the a lot of analysts are predicting, that to 2023 the interest rates might have been peaked out, and 2024 the Fed maybe in the second half could try to cut down the interest rates or just keep the interest rates same. It depends on the inflation, and that's why I think all eyes will be on Fed, because this is going to decide whatever Fed does. It's going to decide what's going to happen with dollar. It's going to decide what is going to happen with gold, and obviously, there are a lot of analysts which are forecasting 2.1% GDP growth in 2024, and inflation should definitely come under control in 2024. So I think this is something which is there, but also we must not forget that the first half of US, a lot of analysts have predicted that there could be a mild recession, and during that course of time, I feel that the central bank would less likely increase any rates. And that being said, the second half is when the growth might come in. So we see for 2024, first half would be slow. Second half, the economy could grow. So it's a slow growth, but it's in the second half. It's going to be very crucial. First half, I think the Fed may not cut interest rates, while US might dip into a mild recession. Of that could be the impact of the aggressive rate hikes which have happened this year. Also, which is what is happening is, there are a lot of IPOs coming in the year ahead. 2023, if we just do a brief review of how the IPO market was in 2023, overall, mostly very inactive. 2023 was not a favorite year for companies to get listed because there were very few deals which happened. Very few companies tried to raise money as compared to the previous years. Right now, a lot of analysts are seeing potential signs of improvement. A lot of deals are actively picking up in the third quarter, and there are a lot of high profile IPOs in the pipeline. There have been around 968 IPOs globally in the first three quarters of 2023, which raised around $100 billion in capital. So, again, this is still 5% less in volume. And if you see 32% less year over year IPOs, and this slowed down because rates were up, inflation was high, there were a lot of geopolitical uncertainties which were going on. So these factors basically made investors more cautious to where to invest. If a new company is getting listed, I may or may not want to. I would not want to invest into that company if I'm surrounded by high inflation and geopolitical tensions. And that was the reason that why 2023 was not a very good year for IPOs. It has been a very lackluster, very few deals, as I said. Um, Now there are signs of improvement. There have been around 137 IPOs on US exchanges so far, which have raised around $30 billion. Again, as I say, it's not much. There have been a slowdown in the IPO activity as the factors we talked about. But now let's try to understand the 2024 landscape for the IPOs. Now, 2023 was very uninspiring, as we say, but there are signs of improvement. As in the last quarter, the third quarter, we have seen a lot of high-profile IPOs are in pipeline. There's a lot of optimism for the IPO market in 2024. But again, investors are going to be very, very cautious, and market is going to be very, very volatile. If we see from US markets perspective, IPO outlook for US market in 2024 is going to be very mixed. There are a number of factors basically that could support a IPO rebound. For those people who don't know what an IPO is, IPO means initial public offering, the first time when a company gets listed in the market and they try to raise money. That is called entering into an IPO. And it's really important that today that we talk about this event, because this is going to be a game changer if it is accepted by people. And as I said, there are a lot of factors that would support a IPO rebound in 2024. Economic conditions improved, inflation has been under control, increased demand for growth stocks. 2023, we saw a lot of tech companies went up. So there's a lot of pent up demand from companies, and there are a lot of companies that have been waiting to go public. And 2023 and 2022 was not a good year. So those companies might get listed in 2024. There are a lot of other factors that could still weigh on the market. If rates go up or inflation goes worse, or any geopolitical uncertainty, that is going to backfire again. So we have to keep these factors in mind. Overall, if I say, a lot of analysts are generally optimistic about the IPO market in 2024. They're also cautioning investors that market is likely to remain volatile. So you should carefully consider the risk, right? You should look at the economic conditions, look at interest rates, inflation, and everything. From a European market perspective, I think there are a lot of headwinds which are coming in, because I feel that for Europe, the ongoing war and the rising rates and inflation, it's something which investors need to be very cautious about. And that is the reason that why we would be looking mostly towards US based stocks as well, and US based IPOs as well. And as I said, there are going to be a lot of companies which will be coming up with the IPOs. Primary companies, as you can see in the slide: Fanatics, which is a global sports merchandise agent. There's a payment processing software, Stripe, and then Cerebrus Systems, which is a leader in AI chip technology. Even in the Gulf, I think in UAE, it is expected that the IPOs will continue. Even in India, after elections, a lot of tech IPOs are being lined up. So I think 2024 can definitely look forward to these IPOs coming in, and this was something which was missing in last 2 years. But now, as I said, there's a lot of pent up demand which is there for the companies, and they're itching to get listed in the stock market and raise money. Another important event is going to be elections throughout the year, because 2024 US elections, it's one of the most important events, and it really impacts on each part of your investment. Um, we have seen that S&P 500 moves a lot during election years. We have seen stock market, they really moves. Commodity markets, even during the results of the elections, market moves a lot. Or most of the time we have seen that a new president which gets elected um, also gets elected for the second year also. So most likely the chances are Joe Biden as a Democrat might get elected again. Now that being said, uh, Republicans are still in line, and we are going soon to do a evaluation session on how US elections would turn like, and what are the chances, and how it's going to impact the stocks and commodities. But for now, elections are going to be in November 2024. So this is just to tell you that be careful, and you need to be watching the US elections for 2024 as well. And that is going to be a very a key uh, important event to take action on your decisions about investment. Um, Again, future proofing your investments. We all know that at the end of the day, we navigate through the market volatility using different strategies. Now that is there, but also we must not forget that the world is changing very rapidly, and because of COVID in 2020, there have been a major transition and a very rapid transition of people towards technology. There are a lot of things which we thought probably could take another 10, 15 years for people to adapt with. That was rapidly adapted due to COVID. And because of this, artificial intelligence, robotics, fintech, EV sector, people getting more aware about sustainability, that has brought a lot of opportunities for the investors as well. So future proofing your investments is all about investing in powerful mega trends which soon are going to transform the economy and also going to transform the investor perspective. uh, Fintech, for example, or you take about cybersecurity, digital assets, AI. I'm sure a lot of you must have heard about OpenAI and ChatGPT. You must know that these companies might also get listed for the IPO in the next few years or next year, and that's why it's really important that we continue to invest into these mega trends, because this is the future. Whether you talk about electric vehicles, whether you talk about DNA sequencing, whether you talk about AI and robotics, these are the areas which definitely attract a lot of attention from investors. And I think investors now have equally become very concerned about the climate change. They have become very concerned about what is going to happen in the future. Are they invested into AI? Are they invested into robotics or not? Are they invested into DNA sequencing or not? These are few companies which these are few areas which definitely make a lot of sense to invest in. Maybe the returns are not immediately, but over a period of time as the world progresses. Imagine there are companies which are using technology, and they are providing technology to improve the agricultural productivity of a land. Now, when something like this comes across as an investment idea, we tend to focus on that. So, and I want to tell this to everyone, there are a lot of questions about currently which people are asking on the chat, that how profitable these investments are. You talk about renewable energy, and you talk about sustainable energy, and AI and robotics, like, because these kind of topics have always been in discussion. But every time somebody talk about robotics, people get excited, but then we think, oh, this is going to happen in 2060 or 2070. But currently, if you see stocks like Nvidia, or if you see stocks like IBM or Microsoft or Amazon, they're growing rapidly, and the amount of progress we have done in last 3 years vis-a-vis technology, it's really commendable, and it's really surprising and very shocking. Um, like Chat GPT is a revolution. AI and other AI softwares, they are getting much better. A lot of current platforms are integrating AI to make the experience much better. And it's only a matter of time till we go through this major technological transformation. And then we'll definitely would want to invest in these areas. So a part of your portfolio, uh, you can dedicate to these kind of investments also. Not saying that you put all your hard-earned savings into electric vehicle sector. No, not at all. I'm just saying diversification is the key. Risk management is the key. I'm going to share a few strategies also with you, which will be absolutely different from what I'm telling you right now. But those will be some form of investments which you definitely can do. Apart from that, keep some money aside and try to future proof your investments, because maybe right now you invest into a coal power or electricity company and you feel that that is the safest. Imagine a world where climate change becomes worse and the government demands a rapid transition from coal and power companies and utility companies to non to renewables. So this is something which is, I mean, it really can happen, and that's why we must understand this, that a portion of our investment should also go to futuristic investments, right? Obviously, stocks versus bonds in 2024. So before we discuss about a stock or a bond outlook, I would want to discuss some strategies with you real quick, because this is something which we have been working so far. Again, it's a very limited time period, so I would want to sit one on one with all of you, and you can come to my office, and we can have a discussion over this, how to properly execute these strategies. But also at the same time, as I said, that I must share the amount of work what we have been doing, and you can just diversify into all these areas. So let me just share it right away. So right here, when we see, I'm going to share with you first a very normal portfolio of a diversified ETF, and let me know if you can see this easy. Hope everybody can see this. If you can't see this, please let me know, and use your chat option to notify me if it is visible to you or not. I guess most of you can see this. I think I'm just facing some network issues, but I hope that everybody is able to see this. I'm just going to show you a portfolio, and these are some ETFs which you can hold on for a longer period of time, and these funds are mixed. So as I said, that you can't exhaust all your savings into one investment asset class. That's why you need to diversify it. So the ETF, or this is the fund portfolio which you see right now. This is uh, allocated in different ETFs, different funds. One of these funds is SPDR S&P 500 fund. So this fund basically tracks the performance of the US stock market index, right? Second is Triple Q Trust Series, which tracks a tech index in US. Then there's the emerging market ex China ETF into Chinese equities. Then there's a Euro stocks select dividend fund, those companies which have really good dividends, so those are clubbed together and put into a fund, so you can invest in that. Arc innovation ETF, slightly high risk, but it's an innovative tech fund you can invest in. Then there are some smaller market value companies which you can invest into, iShares core S&P small cap ETF. So similarly, gold shares, bond based funds, and you can invest into all of them, not at once, different phases. What we call it as a ladder portfolio, where phase one you invest 20% of your money, then phase two 40%, and then phase three 40%. So sometimes it's wise to, if you want to invest $10,000 into one fund, wait till it starts coming down at different phases. So you start with a smaller portion. If you want to invest $10,000 in that fund, start with 2,000 first, then 4,000, then 4,000. So this is something which is called a ladder portfolio, and you can invest into. Look at this, the fund which I just shared with you. The top holdings in this fund are Apple, Microsoft, Amazon, Nvidia, Alphabet, Meta, and this is a completely tech related fund, as I was talking about. But if I show other funds also to you, let's say the triple Q series, top holdings, again most of the tech companies. Then there's the emerging markets ex China ETF. If you see the top fund holdings, Taiwan Semiconductor Manufacturing, Samsung, Reliance Industries, ICICI Bank, Infosys, SDFC, Whale SA, MediaTek, Honzai Precision Industry. So that ETF is tracking very broad-based emerging market equities, and you can check most of the emerging markets like India and China are into this. Then there is a Euro stocks fund which has companies like ASML, Louis Vuitton, L'Oreal, Sanofi, Siemens. If you see, there are dividend-based funds, which companies which have like good dividends. Altria, Verizon, IBM, AT&T, Philip Morris, Seagate Technology, ARC Innovation Funds, slightly on the high risk side, but this has most of the tech companies like Coinbase, Zoom, Block, DraftKings, Unity Software, and smaller market value companies like BlackRock, Fabrinet. There are funds which you can help you invest in this. And then one of the most important ETFs, consumer staples, something which a lot of people would invest during uncertain conditions, because these companies are really blue chips, and companies like Procter and Gamble, Walmart, Pepsi, Coca-Cola, Mondelez, Colgate, Target, all of these kind of companies. Then there are some gold funds as well, where mostly the exposure is taken in gold, mostly long positions. So you can take exposure in gold-based funds as well. So this being said, again, there's a bond fund as well, which invests into investment grades like HSBC bonds, JPM bonds, all these kind of bonds you can also invest in. So these funds are available on one single platform, and you can diversify through on these funds through different platforms. So one strategy is buy these funds and hold on to it. And these funds are a mixture of tech companies, main companies, emerging markets, smaller market value, bonds. So you get an overall exposure. And that's how you navigate through the financial terrain first. You start diversifying your portfolio a lot. So that being said, this is one. Second, let me just uh, start with. Okay, now here, one more strategy which I'm going to share with you. Um, some corporate bonds. This is something which is, again, a lot of investors like to see this. Yeah, I hope everybody can see this. Please, if you can write a yes or a okay every time I change the screen, because I just want to make sure that all of you are able to see this, right? All of you can see this, right? The investment grade corporate bond ETFs. Okay, perfect. All right, I think most of you can see this. That's great. So, what you see right now is a portfolio of investment grade. What is investment grade? The corporate bonds. Bonds is an investment which allows you to earn interest over the money which you have lent to either a government or a company, and you do that by purchasing bonds of that company. And it's one of the most less riskier investments as compared to other investments normally which you come across, like equities and cryptos. So this is one of the less riskier investments, because you are entering into a bond where you are promised to pay your to get your capital back after a stipulated time period if you hold this bond through its maturity. And by the time, as long as you're holding this bond year on year, you earn a interest as well, just like how a loan works. Instead of you being the borrower, you are the lender, and you are lending this money to either a government, which is called a government bond, or a company, which is called corporate bonds. So the portfolio which you see right now is corporate bonds portfolio, and that will give you around, if you see the yields of these bonds, you're getting around 8% return on bonds like HSBC, or 6% on PNC Financial Services, 5.5% on Barclays, 5.8% on Bank of America. And these are corporate bonds. These are called investment grades. Investment grade bonds are those bonds which have a very strong credit worthiness, and the chances of bankruptcy for these companies are relatively less as compared to others. So that's why a lot of investors, they like to diversify into investment grade corporate bonds also. This also can be a part of your portfolio because it's a fixed income instrument, and you don't need all speculation. You need some fixed income also in your portfolio, right? So that is another way you diversify. uh, Going forward, let me switch screens and I'll show you one more uh, here. Okay, screens, and right here. Okay, now another strategy which is really going on right now, and we are looking at it now. This is a pair trade. um, for those investors who have not done a pair trade before, you need to understand what is short selling. And if you come to my office, and so Century Financial, we are investment consultants, and along with providing consultancy services to the clients, we also teach them and train them, and support them about market awareness. So a lot of times, the prospective investors, they come to us, they learn and understand the process of how investments is done and how trading is done, and we teach you free of cost, without any commitment. And that is what something which we are known for. So I'll very quickly tell you how this strategy works. The strategy, as you see in the flyer, involves two instruments. One is the Switzerland index, right, and the South Africa. Switzerland 20 means the Switzerland index, which comprises of 20 companies, and the performance of this index goes up and down depending on the performance of those 20 companies in Switzerland. South Africa 40, as the name suggests, 40 companies in a South African index, which basically allows you to take an exposure in South African markets. Now, this strategy, it requires for an investor to go short, which means you go short on South African index. Though for those investors who don't know what is short selling, let's have a session later on. I'll explain it to you. But just to brief you, short selling allows you to borrow the instrument or borrow the product from your broker and sell it in the market if you're expecting that the price of that particular product is going to fall. And while you borrow it from your broker and sell it in the market, once the price comes down, you can buy it back at a cheaper price and give back the product to the broker, while the price difference or the profit which you earn by buying it cheaper, that remains with you. I can give you more examples of short selling once we meet and connect. But this strategy is based on short selling the South African index, and simultaneously, as you can see it read, they go long or buy the Swiss index. Now, when you do that, uh, investor is likely to receive a holding cost of 6.2% on South Africa when you short sell South African index. But on the other hand, you will have to pay a holding cost of 3.7% on Swiss index. But still, on net basis, you will earn around 2.5% if you leverage two times. Again, we can have a proper one-on-one session where I can understand, where I can make you understand how leverage works. And we bring you last 10 years of data, where you can see instead of 20 and 2022, which have been like really horrible. Most of the time South Africa has outperformed Switzerland year to date. Sorry, a lot of times South Africa has outperformed Switzerland year to date. The holding cost strategy minimizes the loss. So look at this: yearly returns from 2014 till 2023. Switzerland 9%, -1, -6, 14, 10, 25. South Africa yearly returns 6, 4, -4, 19, -11, 8, 7. Now, if you had bought Swiss index and shorted South Africa as it shows in the strategy, as you can see, most of the times the return would be 6% negative, 2.6% negative, 5.5% negative, 6.2% negative, 3.01% negative. But the best part here is the net holding cost which you receive in South Africa, and even after you pay uh, the holding cost for the Swiss index, you still end up earning a modest profit. And that is the reason that why this strategy has been put together. How holding costs work is something, again, we have to sit and understand. uh, we have to teach you how the trading platform works. Again, guys, this is a strategy for slightly experienced investors. If you are new to the market, I would not recommend you to get into this right away. Even if you're experienced in the market, please talk to us before you get into any kind of the strategy which I am discussing it with you. Because once we do that, once we sit and discuss how this works, you will get the idea of how to use these strategies in your favor. And there are a lot of other strategies just like this where you can buy one and short sell another, and you can um, uh, create a arbitrage for your own self. Of course, it's not going to be a risk free product. There will definitely be risk, but those risks can be managed, and that is where Century as consultants come in to tell you that how these strategies are done. And most important, never forget that your conventional forms of investments are always there: your stocks, your bonds, your ETFs. This is something which is a little extra, which is something which will definitely help you to navigate through this year or navigate through the next year of uncertainties. So that's why you always try to come up with different strategies which can help you to manage your risk and minimize your loss, right? Now, that being said, as we were talking about stocks versus bonds in 2024, I feel that a lot of investors currently are flocking up the bonds right now. They're buying bonds because interest rates hike has been very aggressive, which has put bond prices down. And 2024 could be the year where bond prices start moving higher. And I think the 5+% interest is not a bad choice for investors. It's not a bad thing for investors. Switching from bonds to stocks, investors must demand a higher return. And at this point of time, and given the uncertainty, I think a lot of people are more inclined towards bonds than stocks. So I think the 5+ interest rate over the next 10-15 years, this is really something which the bonds should deliver. And that's why I think this could be a part of your portfolio as well. Three commodities that could really take off in 2024, because for much of 2023 commodity markets trading water, Russia's invasion of Ukraine, there were a lot of supply chain disruptions. We saw a lot of raw material prices soaring up in 2022. Again, oil prices have perked up. There are a lot of demand and supply problems in 2024, also supply problems. With resurgent demand, it could cause a lot of these commodities to take off. First, I would like to talk about crude oil. Most of the analysts are feeling that new supply will combine with slower economic growth, and it might cause a gradual decline in the oil prices. Um, Now, in September, we saw prices were around 90. Currently, it was around $80. Maybe in 2024, the prices are likely to remain around 70 to 80. If this is what it stays, that could prompt Saudi Arabia, who is the world's largest producer, to announce some output reductions. And cutting the output again can bring oil prices higher. Iran's production may also be dented by the sanctions or the shipping problems due to the geopolitical uncertainty. Now, that could set the stage where the economic outlook for oil becomes slightly bullish. So, I think oil prices for 2024 might rally, giving the idea that geopolitical war still or geopolitical tensions still remain, and the supply disruptions might be there. Output cuts might happen from Saudi. Overall, the current oil price, which has come around 72 to 80, might go up around 85 to 90 as well. There are a lot of metal markets that also look vulnerable. If you see cobalt, lithium, these are kind of green metals as we call them. On everybody's, they were on everybody's radar in 2022, but the supply has been enough for both of the metals. And I would suggest that now you should have a look at the copper prices, which fell a lot during 2023 because Chinese growth got impacted. So right now, the hottest of all meta markets could be the ultra niche, and that is uranium, because currently Ukraine have made governments hungrier for atomic energy, and there have been conflicts and coups, and this has really disrupted uranium production. So keep a check on uranium prices. I think that is something. There are a lot of funds which, by the way, gives you an exposure in uranium as well. Grain market or agricultural commodities is going to be the third area of interest. Russia's invasion of Ukraine, it did not jolt the market for long. Wheat prices were high in March. It came down in 2023, but we should not forget that Ukraine is the world's fifth biggest exporter, and it now exports around 35% less. So bumper crops from Russia have made up the difference, but bad weather is escalating the tensions, and that could really jeopardize that. So we might see a lot of agro commodities again. The prices might go higher. So that could also be the part of your portfolio. And that being said, I'm sure there are a lot of questions which you have, and some of these questions I can see. If there are any specific sectors you can outperform in 2024, I think real estate is one of those sectors, because 2024 interest rates have 2023 interest rates have peaked. 2024 interest rate might start coming down, so that might bring more investors, since the loans are going to be cheaper. So a lot of pent up demand from real estate could be there. Another area could be tech, because technology 2023 recovered a lot, and with a lot of tech IPOs coming in 2024, it might give a good nudge to the tech sector. What should the investor be cautious about? As we said, all these events, IPOs, which are coming in, US elections, geopolitical tensions, Fed reaction on the inflation. These are some key events which you should be very careful about. Will 2024 be a good year for the stock market? Uh, Maybe first half we might see some decline. In last 50 years, what we have observed is every time when central bank is about to change their course from rate hikes to um, going stable and not increasing any rates. We have seen stock markets already cashing on that news, and it goes up, and after that, the market starts coming down. So 2023, I think stock markets have already rallied. First half of 2024 is going to be slow. We might not see too much excitement in the stocks. Second half, as the rate comes down, interest rate comes down, inflation gets under control, and if geopolitical tensions do not go worse, I think could be a good year for the stock markets as well. Right. There's a question: when will you be available for one-on-one? The one-on-one meeting can definitely happen. I think yeah, this is something which we do after every session. As you have attended the session, you are definitely eligible to have a one-on-one discussion, at least 2 to 3 meetings if you wish to. And I will be sitting in my office in Emar Square, Building 4. Anytime you want to have a session about understanding more of this, about day trades, about how to use the platform, leverage, short selling, anything. I'm available either on Zoom, Microsoft Team, or physically in the office. Please do come. I think this is something which we do a lot for our clients, and these are free of cost sessions. Please do review us on Google and Century Financial. This really motivates us to conduct more and more sessions week on week. And thank you so much, all of you. I see a lot of people here who came an hour ago and still continue to sit. So thank you so much for your patience, and thank you so much for your questions. We'll be meeting you really soon next week. And next week, we are definitely going to talk about some other topic. These are few topics which we will constantly talk about, because as 2024 approaches, a lot of people are still interested to know the key events to look out for and the investment opportunities in 2024. So we kind of keep repeating these sessions as well, because um, uh, 2024 is going to be again a very hot year in terms of financial markets, and people who have missed this session would want to know again. So next week we are going to come up with a different session, of course. And as I said, if you want to come down to the office, I'm definitely available. Just book your time a little prior. You can talk to your relationship manager who has signed you up for this webinar, and I'll definitely be available to sit with you and discuss this further. So once again, thank you so much for your time, and thank you so much for your patience. I'll see you next week. And till then, good night. Have a great health, and continue to trade, continue to invest, and be safe.